All right, folks, welcome back to Daily Market Narrative, the show that tries to make sense of the financial madness you see on your screens every single day. I'm Dave, and today we're diving headfirst into the sticky, gooey, molasses-like situation of sticky inflation fears and the Fed's increasingly nervous dance around it. Apparently, the market is doing the cha-cha between, oh no, rates are high, and wait, maybe they'll stop being high soon, all while the Federal Reserve, bless their pointy heads, is trying to figure out if they accidentally created a monster with their rate hikes. It's a classic case of damned if they do, damned if they don't, and we, the lovely investors, get to watch the fireworks, or in this case, the slow, agonizing fizzle. So, the prevailing narrative, the one you'll hear from your CNBC overlords and your financial gurus, is that inflation is being a stubborn mule. It's not budging, and because of that, the Fed, those benevolent guardians of our wallets, are going to keep rates higher for longer. Think of it like this. You want to go on a fancy date, but your wallet is stuffed with IOUs from that questionable crypto investment. That's pretty much the market's mood. Higher rates mean borrowing costs go up, companies get squeezed, and suddenly buying that new Tesla feels as appealing as a root canal. So, we're all standing around nervously checking economic indicators like we're waiting for a text back from that crush who said they might be busy. Will they hike again? Will they hold? Is Jerome Powell secretly a stand-up comedian who just loves to keep us guessing? The uncertainty is the real villain here, folks, a classic plot device to keep us glued to our screens, hoping for a positive plot twist. Now, let's peek under the hood, shall we? Because what's a market update without a look at some squiggly lines that can apparently dictate the fate of trillions of dollars? So, the SPY, our trusty ETF proxy for the S&P 500, is looking, well, it's looking like it's trying to find its footing. On the big picture, the weekly and monthly charts, it's still a pretty picture. But the daily chart, that's where the drama is. It's like it's looking for a prop, a little boost, to push it up to the 660s. And the magic words for that boost? As long as supports at 640 and 620 hold. If those levels crack, well, let's just say your portfolio might start looking like it went through a particularly aggressive spin cycle. So, keep an eye on those numbers, folks, because apparently they're the secret sauce to market domination, or at least the secret sauce to not losing all your money. All right, let's cut through the noise and get to the headlines that actually matter, or at least the ones that are making the most noise. First up, we have Trump escalating his pressure campaign on the Fed, calling for Lisa Cook to quit. Apparently, there are allegations of mortgage fraud. Now, Cook says she's not going anywhere, which is a bold move, I'll give her that. But this whole political pressure cooker on the Fed, that's like adding gasoline to a fire that's already burning down your house. It injects uncertainty, and uncertainty is the market's favorite flavor of poison. It makes investors nervous, and nervous investors tend to do silly things, like sell everything and go live in a cabin in the woods. Then we've got the Fed minutes, which basically confirmed what we already suspected. They're divided, they're worried about tariffs, inflation, and the labor market. Some folks at the Fed think inflation is the bigger monster. Others are worried about jobs. It's like a committee meeting where everyone's got a different idea about how to escape a burning building. And tariffs? They're a considerable uncertainty, which is Fed speak for we have no earthly idea how this is going to play out. This division is like a split personality for monetary policy, and the market hates split personalities. Speaking of uncertainty, stocks are wavering ahead of Jackson Hole, and tech is looking a bit bruised. Bloomberg Brief is saying we shouldn't expect a hawkish turn from the Fed, which is good news if you're looking for a pivot, but bad news if you're already invested in those high-flying tech stocks that seem to be powered by pure optimism and venture capital. And the tariffs? They're a slow burn. So basically, we're all just waiting for the Fed chair's speech like it's the season finale of a really boring drama. And, wouldn't you know it, U.S. stocks are poised to extend their losing streak. 4th day in a row, folks. Investors are questioning those sky-high valuations, which, let's be honest, are starting to look more like fantasy novels than financial statements. Retail earnings are rolling in, and it's a mixed bag. Tech and consumer discretionary sectors are leading the losses, which makes sense. When you're worried about inflation and the Fed, you tend to cut back on the non-essentials, like that artisanal cheese you've been eyeing. Now for something completely different, oil. Oil prices are holding our gains after the biggest drop in U.S. stockpiles in 2 months. That's a good sign for oil bulls, but don't break out the champagne just yet. Oil is still down year-to-date because, surprise, surprise, trade policies and increased OPEC Plus production are still weighing on the market. It's like a hangover that just won't quit even after a good night's sleep. And in a truly heartwarming story of global cooperation, the US and EU have spelled out tariffs for autos and pharmaceuticals. We're talking about a 15% tariff on most EU imports, including cars and drugs. The US will keep its current 27.5% tariff on EU cars until the EU plays nice and lowers its own tariffs. It's a trade war, folks, but with more paperwork and less shouting. This means higher costs for consumers and potentially some headaches for car manufacturers and pharma companies. Finally, let's talk about Christmas decorations. Yes, Christmas decorations. Apparently, tariffs are threatening the very industry that brings us joy and tinsel. Most of these shiny baubles come from China, and those new tariffs are already costing companies a fortune, especially since they have to ship these things months in advance. So, if your Christmas lights are a bit pricier this year, you can blame the trade war. It's the gift that keeps on giving. To the tariff collectors. Oh, and in a truly fascinating geopolitical twist, Ambani is caught in a US-India trade skirmish over Russian oil. The U.S. Treasury Secretary is not happy with India for buying Russian oil and military equipment, and specifically called out India for reselling refined Russian oil. India, meanwhile, is reviewing the implications of U.S. tariffs. It's a complex dance of energy, defense, and trade, and it's making global energy markets and bilateral trade relations a bit twitchy. All right, what's on the horizon? Well, the big one, the event everyone's waiting for with bated breath, is the Jackson Hole Symposium. This is where Fed officials gather, polish their speeches, and try to give us some clues about what's coming next. Think of it like the Met Gala for central bankers, but with more serious implications for your 401k. We also have Fed Bostic giving a speech, which might offer some more color. Then there are the usual suspects, initial and continuing jobless claims, which will tell us if people are still losing their jobs or if the labor market is holding up. We'll also get a look at the Philly Fed Manufacturing Index, which is like a weather report for businesses in that region, and includes vital sub-indexes like prices paid and business conditions. And of course, S&P Global Manufacturing, Services, and Composite PMIs will give us a broader picture of economic activity. Oh, and existing home sales, because apparently everyone is still trying to buy a house even with these mortgage rates. We've also got some bill auctions and mortgage rate updates, which are basically just more data points in the grand symphony of economic noise. So, to wrap it all up, the market is in a holding pattern, waiting for the Fed to make its next move, all while grappling with inflation, tariffs, and the general existential dread of a potentially slowing economy. It's a lot to take in, I know. But remember, even in the face of uncertainty, knowledge is power, and a good sense of humor doesn't hurt either. That's all for today, folks. Stay invested, stay informed, and try not to panic sell your Dogecoin. We'll see you tomorrow.